Is VTI ETF the only stock investment you need? A deep dive into its pros and cons here. The allure of a single, all-encompassing investment solution is undeniable. In the realm of exchange-traded funds, ETFs, few options captivate investor attention like the Vanguard Total Stock Market ETF, VTI. Claiming to track the entire U.S. stock market, VTI promises diversification, simplicity, and potentially market-matching returns. But is this one fund wonder truly the holy grail of investing, or does it harbor hidden drawbacks? To unveil the truth, let's delve into a QA exploration of VTI, analyzing its strengths, weaknesses, and suitability for various investment goals. What exactly is VTI, and how does it work? VTI is a passively managed ETF offered by Vanguard, one of the world's largest investment firms. Unlike actively managed funds that employ analysts to select individual stocks, VTI passively tracks the Wilshire 5000 Total Market Index. This index encompasses roughly 4,200 U.S. stocks of all sizes across diverse sectors, from household names like Apple and Amazon to smaller, less-known companies. By holding a basket of stocks mirroring the index, VTI aims to deliver the overall performance of the U.S. stock market, minus any fees. Sounds great. Why not just invest in VTI for all my stock needs? VTI does boast compelling advantages here. 1. Diversification. With such a vast array of holdings, VTI minimizes your exposure to any single company or sector. This spreads risk and reduces the impact of individual stock volatility on your portfolio. 2. Low cost. VTI's expense ratio, the annual fee charged for managing the fund, is a mere 0.03%. This minimal cost translates to significantly more of your returns reinvested into your portfolio compared to actively managed funds with higher fees. 3. Convenience. VTI offers the ease of a single investment vehicle, saving you time and effort from researching and picking individual stocks. 4. Transparency. The full list of VTI holdings is readily available, allowing you to understand the underlying composition of your investment. But surely something so simple can't be perfect. Are there any downsides to VTI? While VTI excels in many areas, it's not without potential drawbacks here. 1. Average returns. VTI aims to mirror the market's average performance, which means it won't outperform a well-constructed, actively managed portfolio during bull markets. Conversely, it may also underperform during significant market downturns. 2. Exposure to underperforming sectors. As VTI passively tracks the entire market, it inevitably holds companies and sectors even when they're lagging. This can drag down your overall returns if certain sectors experience prolonged slumps. 3. Lack of customization. VTI offers no control over individual stock selection. If you have strong convictions about specific companies or sectors, VTI's broad exposure may not align with your investment thesis. 4. Limited tax efficiency. VTI distributes all capital gains and dividends to shareholders, potentially triggering tax liabilities even if you reinvest the payouts. For tax-sensitive investors, alternative options like tax-advantaged accounts or index funds with lower turnover may be preferable. So, is VTI right for everyone? The answer depends on your individual circumstances and investment goals. Here's a breakdown for different investor types. 1. New investors. For beginners building their initial portfolio, VTI can be an excellent foundation. Its diversification and low cost make it a low-stress, low-maintenance entry point into the stock market. 2. Passive investors. If you seek long-term capital appreciation with minimal effort, VTI aligns perfectly with your goals. Its broad exposure protects you from stock-picking pitfalls and eliminates the need for constant market monitoring. 3. Risk-averse investors. VTI's inherent diversification lowers your overall portfolio risk compared to concentrated holdings in individual stocks. This can be particularly appealing for investors prioritizing capital preservation. 4. Retirement investors. VTI's long-term focus and low cost align well with retirement savings goals. Its broad exposure can provide stable growth over decades, contributing to a secure nest egg. Okay, VTI's not for everyone. Are there alternative investment options? Absolutely. Depending on your investment goals and risk tolerance, other options might be better suited here. 1. Sector-specific ETFs. If you have strong convictions about certain sectors, sector-specific ETFs offer targeted exposure, potentially outperforming VTI if those sectors experience significant growth. 2. Actively managed funds. For investors seeking to potentially outperform the market, actively managed funds with skilled managers can be an option. However, be prepared for higher fees and the inherent risk of underperformance. 3. Individual stock picking. For experienced investors with strong research skills and risk tolerance, hand-picking individual stocks can offer the potential for higher returns than VTI, especially during periods of market outperformance. However, this approach requires significant time, effort, and expertise to analyze companies, predict market trends, and manage portfolio risk effectively. It's also inherently riskier than VTI's diversified portfolio, potentially amplifying losses if stock selections falter. Should I completely avoid individual stocks then? Not necessarily. A small allocation to individual stocks within a VTI-based portfolio can add a touch of personalization and potentially boost returns if done strategically. However, it's crucial to maintain your core holding in VTI for diversification and risk mitigation, limiting individual stock investments to a portion of your total portfolio that you're comfortable risking. So, the bottom line. Is VTI the only stock investment I need? There is no one-size-fits-all answer. VTI is a powerful tool for investors seeking diversification, simplicity, and market-matching returns. But it's best understood as a foundation, not a complete investment solution. Consider your goals, risk tolerance, and investment experience before deciding if VTI is the sole driver of your stock market journey. Remember, a well-constructed portfolio often blends VTI's broad exposure with targeted investments in specific sectors or individual stocks, tailoring your holdings to your unique investment objectives. Ultimately, the decision of whether VTI is enough for your stock needs hinges on your personal financial blueprint. By understanding its strengths and weaknesses, weighing its suitability against your goals, and potentially complementing it with other investments, you can chart a course towards success in the vibrant and ever-evolving world of stock market investing.